Then he's going to talk about risky capacity equilibrium models with incomplete risk trading.
Okay, so the first thing to say is there may be, I don't know, one person in the room who is in the audience of 5 that heard essentially the same talk at the Informs meeting in Phoenix. I think I was at the very last session of the last day, which is always the graveyard shift is always kind of nice. A very, very quiet, very polite audience. So apologies if you've seen this before. The normal, for me, cast of characters, so this has been like the same topic for about 10 years. So, I don't know how much is new here because bits of it have appeared in dozens of places. So we have the same thing that Eve introduced in a lot more detail. So we're looking at long-term investment decisions. And today, as it were, which I'll call stage 0 later. Is this working? Can everyone hear me?
Yeah.
Okay, great. Today, which I'll call stage 0, you can invest in plant. It could be multi-stage, but I'm not going to write any of that down. You can invest in plant, but you can also invest in financial contracts to help hedge things. For example, fuel prices would be a standard one in the old world. We're not considering strategic behaviour with respect to either the way you sell your electricity at the point of production or the fact that you investing now may deter other people from investing because they figure there's going to be too much capacity. So both of those effects could be considered, but we're not going to make the models a little bit more tractable. There are other reasons to do that as well. What kind of uncertainties? Well, I mean, anything I suppose you can imagine. So here I've got fuel prices, maybe carbon prices, weather, demand, and so on and so forth. Largely concentrating on perfect competition. There is a paper here which I'll mention again later. It's an EPRG working paper which has got, I don't know, 3 or 4 topics in it, and I'm really kind of focusing on 1 or 2 of them here. So just a quick poll, because we have people who represent, let's say, different geographies, but also very different organisations. So various of us have worked with energy companies, regulators, and so on. So I'd just like some comments from the group on where you've seen risk being material or perhaps not being material. And in particular, the second question, what about the trading of contracts? Because effectively that's what we're going to be using as a way to mitigate the risk that people... So, yeah, comments. So I can see Dick O'Neill is not going to escape. He's sitting at the back. But we have experience with EDF, for example. We've got lots of experience in the room about New Zealand electricity.
Risk is frequently invoked.
Okay, and so where is it? Who invokes it? Is it the
large consumers?
Okay, large consumers. So New Zealand Steel or something.
Generators.
Large generators?
They're always worried. Yes.
And what are the large generators worried about?
Dry years.
A dry year.
Because they're gentailers.
Okay.
So they say.
So they're worried about, they've signed effectively a long-term contract with their customers? Or it's a social contract maybe? I don't...
No, they have to commit to some tariffs
Okay.
ahead of the day.
Okay, and the tariffs are imposed on them, or they just agree to do this because that's what people
Well,
want?
they have to do that for their consumer wing.
Yeah,
And
okay.
they have to go purchase up from wholesale.
Okay, so this is a sort of natural thing, long-term contracts where someone wants security of pricing, I suppose.
There's also a swaption contract between a large thermal and the hydro plant.
Okay, so this is a really interesting one. So do you want to say, do you give 10 seconds to the room to explain what that is?
Well, when it's dry, what happens is the thermal plant is generating a lot, making a lot of money, and if it's wet and there's plenty of water, then the thermal plant can't run because it's basically the market rate of water is low. So prices are low, and so the thermal plant is sitting around for years and years waiting for a dry year. And instead of having a capacity market, which we don't have, we have an option, what's called a swaption contract, where the hydro owner pays the thermal guy to stick around, and then an option payment, and then he has enough to cover his capital costs. So that's
Great. So I've been talking with, oh great, I was going to say, please go ahead.
So in Norwegian electricity production, typically companies do hedge their operations in order to have lower cost of capital. They want they want high debt share, so they need to hedge just as part of the deal for the banks. In hydro, there's really nothing that can threaten the business model, so why hedge? But it's just because of the cost of capital.
So this very much is in line with Eve's talk, right? So project financing, you're going to get a different discount rate for a different technology and a different market. I was going to say, Asger, I don't know if you want to add anything, because I know we've been chatting.
Yeah, so one of the interesting questions we're looking at is what would it take to get hydro producers to invest more in peak capacity, and in Norway that would mean also we need some more cable going out of Norway to the countries that will need that peak capacity. And we get mixed answers if we ask the question like, would you like to see a capacity market to incentivize that, or would you rather like to let the markets decide the price and have exactly like Andy mentioned some periods with very high prices, and we get mixed answers.
Okay. So I said Dick wouldn't escape. Dick, what does FERC care about risk? Is risk just something that the individual generators worry about, and you just make sure that it's an even playing field and let them get on with it? Do you have views on?
Well, the biggest risks are probably to the transmission planning system, and risks are sort of politically induced. The FERC sets the rates for transmission and does the transmission planning or oversees it. States have eminent domain authority, which creates sort of two checkoffs, and so you can put down a lot of money and all of a sudden find that you don't have the appropriate government approvals. That's a sort of a government imposed risk. But we pretty much let the generators do their own thing. I don't think there's a serious concern about generators, or that FERC takes into account when dealing with generators.
Okay, thanks.
And as a general rule, is in the ISOs, there's minimizing unnecessary risk. For example, there's virtually no delivery risk inside an ISO. There's it's almost it's very low probability that you won't actually get electricity delivered. So the whole risk is hedging your prices.
Okay, and I think we heard when David introduced this entire week, he talked about capacity markets, particularly in the UK and Europe, because of that's a risk recognised at the system level because of the subsidies for renewable, which is making existing or perhaps prospective thermal plant unviable. And so how do you manage that? So there is risk, obviously, that's considered at system level. I guess I got a lot of answers, which is to say this isn't purely about arbitrage. So there will always be traders out there who are happy to trade on power contracts without really being generators themselves or retailers themselves, which is of course fine. But that's not what this is actually about, this particular talk. Interestingly enough, I guess when we submitted a version of this talk to a well-known journal, we weren't very convincing, let me put it that way. So why is it relevant to study risk aversion electricity markets? Is there any evidence that decision makers in these markets are risk averse? Which it's sort of breathtaking in its lack of connection with the world that I see. But as I said, I guess you can blame the authors of the paper for not being more concrete. So there are all sorts of things here. Fuel, there's long-term contracts and price. It's tricky, but we heard that they may be required if you're a gentailer. Asset swaps, this kind of thing. So lots of, and you can go on and write a longer list, of course. What the point I'm making here is this is not some fiction that a mathematician like me just kind of made up because it was cute. But I guess whether or not we'll ever get this thing published, maybe we'll take it to a mathematics journal where they don't care. Right, so I'll go through this fairly quickly because it's kind of standard, and I've probably got until what time I'm meant to finish, Andy?
You've got till 10:45.
And I'll try to finish a bit early, obviously. Yeah. Okay, so because Eva set everything up, I don't do anything nearly as complicated. I'm feeling like I think I've heard Michael Ferris refer to himself as a plumber. I'm feeling a little bit like a plumber here. This will be a theoretical talk, but it's not theory of finance or theory of economics. It's just mathematical modeling and some kind of stylized models, okay? So this is our kind of standard model. As I said, it could be multi-stage, it could be any number of agents. It has all of the normal unpleasant assumptions in terms of convexity. So there are no startup costs here, things like that. When you talk about capacity, capacity can be epsilon to as big a number as you like. Well, actually, plants tend to be a little bit more discrete. So I'm ignoring a lot of the real world features in order to get something that was amenable at least to game theory, if not to convex optimization when you're lucky. So stage one is in the market. I've already got a plant. And let's just say that there's exactly one generator. The generator's already built a plant of capacity X. You're in a particular spot market scenario, so I don't know, you know what demand is going to be, you know the sun is shining and blah, blah, blah. And now it's just a question of doing dispatch effectively. So think of this as basically at the dispatch level. So you've got a production quantity, you've got a quantity sold in the market, and they will, supply will equal demand at equilibrium, and that's the role of efficient pricing. So no surprises there. And in this very simple world, in each scenario omega, you have a nice convex cost function. There's the revenue you get is on the right. So I've written this as minimized cost, but of course it's the same as maximizing revenue. There's elastic demand here. It needn't be elastic if you prefer a model where everything's fixed, but then we have to introduce shortage, so I've removed that complication. And then you have some sort of market clearing here at a positive price. Supply will equal demand. So nothing special. Now, once you start worrying about what you do worry about, which is the fact that life in the future is uncertain, then the natural thing for people in this room to do is to open up Bergin-Levaux on multi-stage stochastic programs or something, and away you go. So that's all we're doing, although this is only basically two-stage. So you have a probability of all of the future states of the world. You give each one of them a probability, and now your return is an average because you don't know which of these worlds that you're going to inhabit, but you assume you do this often enough that the average is what the average tells you whether you're making money or not effectively. So that's this bit. And before you get to that market, now you have this chance to invest, and there's your capital cost. So this is a much simpler view, but sort of much simpler view of what he produced. There are no discount rates or anything like that here. Now you may have some, a budget on how much you can invest. This is purely stage-wise, so that's the same as before. I've sort of stuck both stages, stage 0, the investment stage, and the production stage are just bundled into one, and it all works out the same. For this to make any sense, of course, in each future period you still need to have some sort of market running, so that last two conditions are stage-wise conditions. That says the market clears in the energy only here. All right, now in the risk-averse case, this is purely a formalism. How does this actually work? One of these it says pointer. Is that actually doing it? So it probably works. Okay. So I don't know. There are some red bits on the slide, and the only thing I've done is replace an expectation by, in my case, it's a risk measure. It could be any convex risk measure, but later on it'll be convenient if it's a coherent. Well, it actually doesn't really matter, I don't think. So these are kinds of utilities. The fact that they're risk measures means they embed probabilities inside them. So these utilities have got probabilities embedded inside. I'm not going to say very much about it, other than that's why we're kind of using them, and a little bit later you'll see a probability pop out, and I'll wave my hands a bit and say it's related to the risk measure. All right, so far we've replaced an expectation by a risk measure, and all of a sudden the retailer now has a risk measure here as well. Okay, so for convenience, if you like, of mathematical modeling, but you might also say to represent the demand side as an agent in some sense, or perhaps it acts as an agent of perfect competition. On the demand side, you might also have a feeling of risk. So it's not just what, it's not, I might operate it day to day, but if you ask me what the value of it is, okay, the value of it might depend on the volatility, if you like. If a life is not perfectly stable, I value it a bit less. So that's what this is saying. All right. Now we could, but I didn't. We could have a capacity here for retail as well, whatever that would mean. Okay. I'm not quite sure what capacity for the retailer would it mean. Would it literally mean, serving more customers? Maybe that's what it means. But just to keep it simple, that doesn't appear. All right. So now it turns out I've written it like this, but it turns out when you solve this, it's separable. Okay, so oddly enough, this is not a sort of a difficult problem to deal with. But we'll see in a minute, as soon as you have contracts, i.e. between the generator and the retailer, that's why this one becomes important. Okay, if you introduce a contract, then there's risk trading between these two, and the risk attitudes will then kind of mesh together. Okay. All right, so risk trading is about contracts against future events. So if the generator believes they know their production schedule for the future and they know the prices for the future, so effectively they know their net cost or their revenue if you want to multiply by -1. So this is a stochastic cost for them in future, but let's supposing they believe they know what it is because they know the prices, they know their capacity, and they've solved out their production. But they've got all these different scenarios that occur on different days. Okay, so that's their stochastic cost. And can it hedge that stochastic cost? Can it find some series of contracts? And again, these contracts we're thinking of if I'm running a thermal plant, and I don't want to fall off the stage. If I'm running a gas-fired plant, then I might have a long-term contract on gas prices, and that's going to maybe reduce the cost in the highest gas price situation, and it'll change the spectre a little bit, and then my risk measure will take that into account, and that's the way that I'll actually rationalize my purchase of contracts. So I guess there are two questions here. What hedges are available in the market, and where do they? If they're in the market, presumably there's some price attached to them. So if someone's offering me the equivalent of an insurance contract, they're giving me something, but they want something back. So how do I price that? So risk trading in power markets. Forward commodity contracts, and I'm thinking of gas, coal, whatever, are certainly present, but as you go out beyond, I don't know, 24 months or whatever, it might depend on the market and the geography, they'll get less and less liquid. So this is a question that was addressed briefly in the questions of the last talk. Forward electricity price contracts are tricky. They tend to be less liquid, and at least anecdotally they're a lot more bilateral or vertically integrated or whatever, so they're less visible. So that's awkward. Financial transmission rights, well, there are lots of things out there that are purely financial but really rely on trades or pseudo trades or zones or some other thing, so fine, that they can help. And lots of stuff, and I think Dick mentioned very helpfully that there are political issues here that kind of get in the way. And one of the political issues that I'm just going to mention here is a carbon price. So who's betting on, so we have the European trading scheme, or the emissions trading scheme in Europe, and then in the UK now we have a kind of floor. But the emergence of these things, and I think David helpfully pointed out, the ETS, it removed sort of unused parts of the scheme, so that in fact the price actually reflected more about usage. Otherwise it might as well be zero. That's again kind of like a market clearing condition. So, but those lurches, if you like, in regulation, you're not going to be able to go to a trader and say, I'm going to make a big bet on a plant which is going to last 30 to 60 years, and it depends on whether it's in the money, depends on whether the carbon is priced globally. Okay, and an obvious example of that is nuclear in the UK. We're we in the UK are desperately trying to restart nuclear, and it's proven to be a technology problem, but actually it was agreed to be underwritten at a very high price by UK government, basically. That's the only way that could be made to work over that many years for something which is way out of the money today. And it turns out the technology is probably killing it, not, I don't know, I should be careful what I say here because I don't know that much about the nuclear industry. All right, so you've got all this incompleteness which is inherent, and the bigger thing here is the further out you look, the more you should expect this to be the case. That's the bottom line. Now, the only case that's easy to analyze is the complete case, and that doesn't necessarily, in this context where we have perfect competition, etc., when you start having complete risk trading, which is a kind of a fiction, but it's a helpful benchmark, you would tend to hope to turn an equilibrium problem into an optimization problem. If you have market power or you have incompleteness, then you're into game theory territory, and finding equilibria is difficult, and multiplicity of equilibria and the like. All right, so let's just go here. Again, supposing that all of our agents have a stochastic payoff, they've done their investments, now they're trading risk. And the key thing about trading risk is they're trading it, in this model, they're trading it between themselves. I don't think it would be I'm not quite sure what would happen if you brought in external arbitrageurs who provided contracts. At least when I've done some back-of-the-envelope scribbles, it's going to rely on, I'm not imagining money's coming from somewhere else in the system. So I don't think this is kind of too restrictive. Maybe there's a bigger equilibrium setting in which there's some other way that you can have contracts arriving. This kind of a risk market is, if you think about this as ordinary commodities instead of financial commodities, and there's kind of perfect competition, again, between the two agents. They don't game each other. Then a price arises which clears the market. It turns out this price is a probability density function if these things are risk measures. Okay, so there is a relationship between your future view of the world, the probability of states in the world, and what comes out of risk trading. Okay, it's a little bit like saying, if you're used to black shoals, you can get a kind of an equivalent risk-neutral probability. It's the same idea, but it doesn't look like it. All right, so here's the full problem now when you've got risk trading and risk aversion. You notice that as well as investing in capacity, you invest in products. There's no capacity investment here, but there's definitely a risk trading going on. You pay something for this, and where does the price of risk come from? There's some sort of clearing going on. At equilibrium, this will clear, and at every stage you're going to have energy clearing. So again, these are formalisms of just sort of stacking stuff up. Now, my one example, I think it's the only example in the paper, just to show you what happens when you start doing this. This is stylized. So there's one producer here. There are various bits about, they have a linear cost function, and there are perhaps from the stochastic point of view, the interesting thing is there are 5 scenarios. To keep it simple, they're all equally likely. And the risk-neutral case is you take an expectation, so you look at every future effectively negative revenue or net cost. You add them all up, you divide by 5. All right, so that's your view of the future. You're trying to figure out how much to invest in today, and you have a marginal sort of a plant per unit of capacity. So this is all kind of linear, and there's in each future period you have to respect capacity. The retailer, as I mentioned before, there's some kind of elasticity buried in this. So if you're going to push the price up, the demand's going to fall, and we represent that by having effectively a demand curve with which is or a quadratic utility, which is like a linear demand function, and the only thing you're doing is shifting it up or down depending on whether it's a sunny day or something else. But this is not intended to be realistic, okay? It's just so that you can see the model at work. So what happens? There are 5 periods. You lose money in 4 of them, and you make a shed load in the fifth, which will remind people, anyone who's lived in a thermal world will recognize peakers here. So this is how you make the peaker work, okay? I'm seeing Anthony nodding because remembering his first or second slide with some negative numbers for thermal plants in Europe. Okay, fine. So this is the kind of standard picture. As soon as you move to this risk aversion and risk trading, so to set that up, I need to introduce a couple of other things. We'll look at three cases where you have no risk trading, you have one kind of contract, so there are 5 dimensions of risk, but you're only going to have effectively one dimension that's traded. Or you can have all risks traded. So we have these 3 different cases of risk aversion. They all use the same risk measure. It's just that the amount of risk trading is being restricted depending on these 3 cases. And did I say, oh yes, we're using this kind of good deal which Eve introduced. You could use any risk measure here, of course, if this is just a formalism. But we did try again to calibrate these towards the Sharpe ratio. So this says something about your attitude of your plant relative to what market expectations are in terms of the CAPM. All right, so the top is risk neutral, and the next best case is the bottom, which is risk aversion is there, so people are worried about variability in the future, but they trade, every possible risk can be traded between them. So depending on whether or not they see the world, how do I put this? If hydro, so this is Andy's example, if hydro could soak up some of the risk of thermal generator, or the other way around, they can get together, right? So if you look here on every conceivable measure, you know, capacity, welfare, total quantity, and price, it's going to be highest here in the risk neutral case and the lowest price. And then once you move into the risk averse world, you're going to get the best results when you can trade as much as possible. So the capacity is dropped from 389 to 349, the welfare has dropped, the total quantity traded is dropped, and the price has gone up. But not as much as if you don't have any contracts at all. Okay. Something else you can look at, that zero, that's sort of the typical perfect competition thing. I don't make any money, and the same thing happened on this previous slide I just didn't point it out. I don't make any money because perfect competition, everything gets driven to kind of zero marginal profit. So what are these numbers? Does this represent price gouging? Well, no, it represents the amount of money that is just effectively I have to buffer myself by because I'm risk averse. So effectively, this is a risk aversion statement. Okay, this is, you know, risk aversion corresponds to that number there. That's how much it's hurting me, if you like. So, and just a quick note, there's a lot of work done by our New Zealand colleagues asking about whether actions like this are due to market power or due to risk aversion. All right, so I've got 15 whole minutes. I'll try to use them, well, 10. I'll try to use them wisely. I don't think I'll have any trouble getting there. The sort of bigger picture is with the tools that we've developed, and we're not the only people working in this area, and I'll show you some references in a minute. All of these cases you can get existence of equilibria for. I didn't say anything about Cournot. Cournot still inspires interesting reactions. I thought some of the talks we had at the beginning of the week here, seems like the industrial organization folks remain interested in, let's say, anti-competitive effects or exercise of market power. When you talk to energy modelers, go to a typical Informs meeting, it's less clear that they have an interest in that subject, and it's also less clear why. So are these purely academic, two academic communities who have different sensitivities, or is strategic behaviour no longer present in the real world? And I don't know. But so obtaining existence turns out to require some work. Interesting that this is what I said before. If you have the risk neutral, perfect competition, multi-stage capacity expansion, that can be rephrased as stochastic multi-stage optimization. Under a complete risk market, you have the same result, except for that the stochastic multi-stage problem becomes more complex, because instead of having an expectation at every stage, you have a risk measure at every stage. But there's some very nice stuff here, and again, some work I think by Andy Philpott and Michael Ferris and Roger Wetz on this. The same thing but with a hydro spin, but it's basically that result. But you get into Nash games and Equilibria rather quickly once you move outside completeness and perfect competition. So this talk is part of a large paper that's been on the EPRG website for more than a year. Corey Cock has an interesting PhD on this subject, and there are various other things here, and I guess I didn't mention, but I could have. Oh, perhaps. Yes, sorry. This slide is about the incomplete case. So that's why I haven't mentioned some other literature. And the point really of this talk, and why I said I felt like a little bit of a plumber or a mathematical modeler, I'm really making a pitch that we don't understand this situation terribly well. The case when you don't have any risk contract isn't necessarily easy, but at least you don't have lots of W's running around as we all trade risk. So at least the number of variables is smaller, but it's still a nasty problem. So you still get gains or equilibria. So let me give you a hint about some of the mathematics of this problem. Now, the way that we've tackled it in the EPRG paper, because we have some tool set to work with something called risky design equilibria, and the tool set allows us to create risk neutral problems, but exactly as in Eve's talk, the probability densities are now idiosyncratic. Each agent in the market is going to effectively draw a different probability density. So that's a little bit awkward. Imagine a risk neutral problem where between 5 of us, we may be acting in perfect competition, but if I have a different stochastic view of the future than you, you're not going to be able to solve that as an optimization problem, because we can't. What do we do with all these different probability densities? Now, in this particular case, I've only got at the point of the risk neutral investment, because it's so simple. Okay, this particular case collapses. I can bundle these 3 things: the investment problem with a risk neutral generator, a sort of a quantity taker, a price taker in retail, and a market clearing. I can bundle all those into one optimization problem. But if you had multiple agents, you'd have multiple of these floating around. Okay, so that's one thing. Now that's the risk neutral bit, but it's the incomplete risk neutral bit, which is to say that the probability densities vary. And then, and as I said, it's in this specific case, it simplifies. But where do these things come from? Well, these densities actually come out of risk pricing. Okay? The good thing about this, and again this ties into Eve's talk, Eve talked about the B's, and in the case when you want non-linear discount rates, not linear discount rates, that takes you into, or one way to describe that, one way to model that is with risk measures. Okay, well, this is something similar is happening here. Okay, so in clearing the price for trading of contracts, you're getting the price of risk, and what you're really saying is these probability densities look the same on the space of traded contracts. And another way to say it is that you can reformulate these as complementarity conditions. So if you want to, notionally, right, you could alternate between an optimization problem where you fix the densities, or more generally, this would be, well, okay, let's just stick with what I've got. An optimization problem where you fix the density. Once you've done that, you've now got these cost streams. So you plug them in here, you find out what the price of risk is, and you just discover, oh, that's now changed. Because I guessed wrong, right? I guessed the wrong density, because I'm not at equilibrium yet, it's a fixed point. So then I go back and do it again. Okay, so there's step 1, there's step 2. So these kinds of things are sort of very suggestive of alternating methods, and it's not a new observation. I'm just kind of pointing out that you can do stuff in computation even if you don't know if it'll converge. At least your laptop will run, right? So you can warm the room for a day or a week and see what happens. Okay, and the concluding thought was that risk management isn't esoteric, it's normal, and I guess somehow we have to get that message across better. Another more economic point, risk aversion itself is not an imperfection. Incompleteness of financial markets is an imperfection. And I think perhaps, I don't know if Jacob was asking the question, why don't more contracts exist? And that's one way to put it. I'm not sure if that's really what you were asking. So if things don't exist, is that an opportunity for trading banks or a government-sponsored green bank to get involved? Or is it just reflective of the fact that there's chaos at the political level and some things will never be priced? And for this community specifically, the reason I'm giving the talk like this is we're a long way from being comfortable about solving these equilibrium problems, particularly if you get into multi-stage stochastic, right? It's going to get traumatic rather quickly without enough an understanding and perhaps ways to simplify the model so that we can guarantee something about uniqueness or something else. So there we go.
Danny's nemesis is gold one.
Far be it from me to be Danny's nemesis. I'm one of Danny's biggest fans. So let me, that's why I have a thunderous booming voice that I will put to use. So let me also thank you for developing all the Numerical work yourself and all the company. That's made all the tools available to this community and has put it in our language. I think it's phenomenal. Anyway, and thank you very much for the nice talk. I have a large number of questions, but I'm limited, so I'll ask one quick clarification and then a couple of questions after that. So please go back to the table that you had in terms of characterizing the risk-neutral outcomes for your example, and then followed by, So what you're reporting here, when you're talking about mean welfare, mean quantity, etc., are these risk-adjusted? So these are with respect to risk-adjusted probabilities, or are you taking the...
I think we did this raw. Gautier, does that sound right?
No, here it's with respect to the normal probability.
Yeah, we just took the welfare and added up, divided by 5.
Yes.
That's what I mean by raw.
Right. So then, I mean, that raises, so I was thinking
good question. Yeah.
So when you go to the complete case, when you have complete risk trading, if you're genuinely believing that the agents are risk neutral and they're not playing on the risk to exercise market power, then those numbers, the 388 in particular and the 491, should probably align.
So actually,
because essentially there is an exchange between the agents.
Okay, I think if I'm getting the picture, if you're able to, is it really possible to do this? My gut instinct is no, but I'd like to be able to explain that.
Okay.
So, the fact that I pointed at this number, even though you've traded as much risk as the market was able to trade,
yes,
you still didn't actually build the capacity as large, nor did you sell the quantity. So I haven't quite answered your question. I'm pointing out a different version of the same question, I think. So I think you're asking, why don't the bottom numbers match the top numbers in some sense?
In some sense, in some risk-adjusted world.
Okay,
that's
but
specifically attributed.
I think the fact that you're risk averse, just because you trade, doesn't mean you get rid of all the risk effects. Is there another way to say this?
I mean, if you add speculators, then those numbers will be the same. If you have outside providers of risk or of financial...
No risk neutral agent here.
No, I was just going to say, the idea that there's a big... If you have... That's right. So when I said before we could have people outside maybe helping us trade risk, but they're going to have to inject something which these agents don't have. And I think that's a good way to put it. If you have a very, very, very large external agency that's risk neutral, which you might say is the government, right? So if the government wants you to do better, then they're going to have to soak up some risk, which means they're going to have to be part of the risk trading process.
Right. So now on that topic, if the government is trying to step in and offer, some kind of resolution of risk, where does that lie in terms of R omega? Is it outside of that, right? So essentially you're looking at your risk instruments from zero products to complete,
yes.
and you're covering all the dimensions, but there's something over and above that, which is required in order to calibrate the risk to the risk neutral.
Okay.
Right?
Yeah.
What's the mathematical relationship there? That's question number one. Question number two.
Okay.
Can you have some kind of a scheme where you say this dimension is more important than the other one? And is there enough sort of left over for an independent agent to enter in terms of, for example, that mean welfare, and be able to have the difference between 491 and 376 and say, I have that support, so I can utilize that to offer these contracts.
Okay, so the first question, unfortunately, I don't have a better answer than the one we just gave. If you want any of these numbers to look more like what you actually need is closer and closer to risk neutral. And in our model, in the complete case, what happens is I have all these probability density sets, which each one of them is associated with a risk measure. And instead of taking an average of my cost, I take the probability density inside that set, which gives me the highest average cost, and that defines my risk measure. I'm risk averse, right? I don't know which one of these densities is going to cause me trouble, so I find the one that's worst from my cost perspective. When you get to here, all of those risk sets of all of the agents through the risk trading intersect. And if you get down to if that intersection comes down to a single, this is a mathematical statement, comes down to a single density, that's the risk neutral density. So if there's a government sitting behind and it's risk neutral, its risk set consists of one density, and this intersection reduces to a single density, and all of us act risk neutrally because the government soaks up all of our risk. Now, how useful is that? Maybe more useful in the context of your second question. Your second question was, could I tell which kinds of contracts might give more benefit? Excellent question. This is a research topic. I guess between you and Andy and your PhD and collaborators, you've actually investigated different kinds of contracts, right? Like, are contracts for differences, what's the difference between the 491 and the 388, and if I only have two kinds of contracts? Honestly, that's the only thing I can suggest at the moment is you have to try to model real stuff. And just plug it in and see. I don't have a really great intuition. I don't know, Yves Gauthier, anyone else? Yeah.
I mean, you need one product, I think, which is the aggregate market, because that's the risk that everybody, all players are taking a part of the aggregate risk. So you need some instrument that's sort of aggregating the total risk. And then for each firm, you need something that hedges their own risk. So if you only have, let's say, one gas-fired power plant, you need one contract that hedges the gas-fired power plant, and then one contract that hedges the overall risk in the market. And once you introduce more different types of generators, you need more contracts. So that's my intuition. I'm not completely sure it's correct.
Well, so I'm not sure what you're describing exactly, because I can already go out and buy, look at the cap again. I can already go out financially and buy what's in the stock market today.
No, I want to have the risk in the market, because let's say it's the sum of the retailers and the generators' profits, and this is risky, and I want to have an instrument that hedges this, and then I want other instrument that hedges my own risk. And as a player, what I'm doing, I'm hedging myself, and I'm selling my own risk, and I'm sharing a part of the risk of the rest of the market.
Well, here's how this corresponds, at least in part, to what you just said. This aggregates the market. That's why this all works. So you get a single risk measure, you bundle everyone's activities into a single function as if it is a single, the welfare maximizing agent, rather than individuals because of perfect competition. So there's the aggregation. It's just happened. Now that doesn't remove the idiosyncratic effects entirely, because otherwise those two numbers would be the same.
No, that's not what I'm saying. I'm saying the okay, maybe I'm taking too much time. So that
Why don't we talk after you can tell me a bit more.
Break for morning tea. I think it's past the 10:45, so let's thank Danny and take it.